Hey, what is up everyone, it's David here. Michael Burry recently said this on a tweet. People always ask what is going on in the markets. It is simple. Greatest speculative bubble of all time in all things, by 2 orders of magnitude. Whenever Dr. Burry says something, the media loves to latch on and
creates this picture where the world is falling down.
The truth is, certain things Dr. Burry say is absolutely correct. But people take it to the extreme. So in this video, I want to break down the tweet and include what Dr. Burry said early in the year so that we can better prepare for the future as retail investors. And no, I'm not going to sell my Tesla stock or my entire portfolio to buy gold or silver bars and hide it underneath my mattress, even though there might be opportunity in those 2 precious metals. As usual, if you do learn something new from this video, it will mean the world to me if you could gently smash the like button somewhere around here. And no, this video is not financial advice or recommendation to do anything. So without further ado, let's break down this tweet a little bit more first on the greatest speculative bubble by 2 orders of magnitude. I can't speak for other asset classes, but for stocks, we can look at the Buffett indicator and the CAPE ratio to try and gauge the valuation of the overall market. Now, the Buffett indicator is essentially the total US market cap divided by the annualized GDP. And you can see that on the 10th of June 2021, that ratio is sitting at 233%. So in the strongly overvalued territory. And the last time it was this high was during the internet bubble. And you can see that the historical trend line for the Buffett indicator is this black line right here. And currently, as it stands, it's 2 standard deviations away from the line. So 2 orders of magnitude, if you will. In order to understand what Dr. Burry is referring to as a speculative bubble, we need to go back to what he said earlier in the year. In this article by Market Insider, which is essentially a summary from a Bloomberg article, Michael Burry is essentially saying that electric vehicles, SaaS, meme stocks, and also Bitcoin is part of what he's referring to as a speculative bubble. But let's focus on Bitcoin first, and then I'll talk about the rest in just a second. He's saying that Bitcoin, and I quote, is a speculative bubble that poses more risk than opportunity, despite most of the proponents being correct in their arguments for why it is relevant at this point in history. He's essentially saying that even though there is validity of Bitcoin being relevant in this point in time, main reason being the Fed printing way too much money, people don't understand the risk associated with Bitcoin. And he goes out to say that if you do not understand how much leverage is involved in the run-up, you may not know enough to own it. If you scroll down a little bit more, fads today, Bitcoin, EV, SaaS, and meme stocks are like housing in 2007 and basically the dot-com bust in 1999. Now, let's quickly take a look at the housing correction, right? So if we go to S&P 500, and then the housing crash in 2007 to 2009 is around that 50% mark. And when we go to the NASDAQ, the dot-com bust impacted this index way more because it's technology companies. And you can see that from the peak all the way to the trough in around 2002, the correction was around 82%, which is quite big. When Dr. Burry started to talk about Bitcoin being in a speculative bubble somewhere over here, Bitcoin had a 600% return in a little bit under a year. There's not that many asset classes that can produce those kind of returns in a span of a little bit over a year. But in saying that, at a 700% return, that is not sustainable whatsoever. So I don't understand the expectation at a 700% return at 12 months time to basically keep going up. At the same time, it's actually really hard to tell how much leverage there is in the system until it crashes. I've talked about this in the past where Binance as a platform give some investors 125 times leverage. So you really don't need the price to change all that much before some investors get margin called. And of course they did. When the prices of a Bitcoin started to go against them because of China reiterating their position or Tesla deciding to no longer accept Bitcoin as a payment, that definitely cleaned out a lot of leverage in the system. If we look at the depth of the crash from peak to trough, it's around a 50% crash. So very, very similar to the housing market crash, if you will. Now, if we're comparing this to the dot-com bust, then it'll be an 80% type crash. At the same time, I keep reminding everyone that when we allocate capital to something like Bitcoin or crypto in general, what we inadvertently signed up to is a very volatile market. Bitcoin's historical corrections in a span of 9 years, there were 6 corrections that was deeper than 50%, 6 of them. And in the stock market, this happens every 6 to 8 years. It doesn't happen all that often. Going back to the article, this is an incredible insight from Dr. Barry on what to be wary of during earlier this year. At the same time, as retail investors, I think we shouldn't brush off all of the bearish points. It's better to acknowledge it and size our position according to the risk and reward ratio. Recently, I made a video on stocks versus cryptocurrency on how I size my positions with something a lot more risky like Bitcoin. So if you're interested in that, I left a link in the description box below. With Dr. Barry comparing the EV industry to the housing market and also the dot-com euphoria, there's some truth to that. Now, this is the price of Tesla over time, and I'm currently a Tesla shareholder and I have around 10% of my portfolio dedicated for that. When Tesla reached around that $800 to $900 mark, I personally felt like it was getting out of hand. Not because I don't believe Tesla can reach that valuation in the future, but it's just because in that moment in time, I felt like it was getting a little bit way too detached from fundamentals. And of course, that valuation didn't last long. It came back down to earth. And I think Barry was talking about this sometime over here. A lot of people believe that his short positions actually started sometime around here. We have no idea whether he still have his short position, but I'm not going to change my position just because Dr. Barry is shorting it. If we look at the peak to troughs of the Tesla share price from here all the way to here, the correction has been around 40%. So getting quite close to the housing market type correction. For a dot-com type correction, then it'll be basically all the way down here somewhere. But I think that's unrealistic to get an 80% type correction on Tesla because, comparing this to some of the dot-com companies is not even comparable. Some of the dot-com companies just had horrible margins. The business model was all broken and internet wasn't quite ready for them to scale just yet. So I highly doubt that we're going to get an 80% type correction. It's more likely that we might breach $500 in the future if it even happens. Because my thesis is that if it gets anywhere between these two regions, a lot of institutions who were not able to pick up Tesla shares and around this region right here would decide to add positions somewhere around here. Just to put things in perspective, for whatever reason, Tesla went to $350 over the next couple months. Based on the current balance sheet and also share count, the enterprise value is around $332 billion. And if we look at the 2021 estimated EBITDA, and we get that number from Ticker right here, you can see that the EBITDA is around $9 billion. The next 12-month EV EBITDA will be around 36 times. For Tesla's next 12-month EV EBITDA, if we look at it over a 5-year span, the average multiple is around 36 times. And the last time it got to 36 was the beginning of the pandemic and the pandemic crash as well. So I'm not saying that there isn't a chance to reach 36 times. There is a chance. I'm just saying that if it does get to 36 times, it wouldn't last very long. And another perspective is that, let's say Tesla's fair multiple for next 12-month EV EBITDA is 36 times. And we'll look at the 2022 EBITDA is around $13 billion. We'll bring the calculator in and then we'll go 13,016 times by 36, which is the fair multiple. And that is the enterprise value in 2022 as an estimate. So $468 billion. Now, if we come back here, bring back the calculator, we'll divide by the current, the near-term enterprise value, 535 minus 1 to get the upside. That's a 40% upside. And if a random Asian dude on the internet can see that there's a 40% upside to Tesla, if it does reach $350, I'm pretty sure the smarter guys, the institutions on Wall Street would not let this opportunity go to waste. And then with the meme stocks, we all know that this have nothing to do with fundamentals and it's more a protest against Wall Street. And the whole point is to drive the price higher and higher so that the short sellers have to close their position. And would this end in tears? Probably, for both Main Street and Wall Street. So what I'm trying to drive home is that as retail investors, we shouldn't ignore everything the bears are saying, especially when it comes to legendary investors like Dr. Barry. And what Dr. Barry is ultimately saying is that there are different pockets of the market that is dangerous and we should be wary of. Those are great insights. And I personally believe that it's a market of stocks, not a stock market. If Dr. Barry believes that there is no opportunity in the market, he will have no positions and in all cash. But that is not the case. So let's look at his portfolio quickly. I'm using a free tool called Whale Wisdom to look at Dr. Barry's fund. His fund is called Scion Asset Management. Yes, although he is bearish towards Tesla, government bonds, growth stocks, and a few other positions. That's why he has puts on them. He also have calls. Now, calls is the right to buy a stock in the future. And you can see that he has call options on Google, he has call options on Facebook, he has call options on CVS, which is a company that I own, and he also has a dedicated position to CVS as well. The point I'm trying to get at is that there is opportunity in the market and we have to look a little harder for them. As retail investors, I'm not going to brush off everything the bears are saying, especially Dr. Burry, but I'm going to be pretty selective with who I listen to. Now, if you want to learn more on how I identify opportunity in a crazy overvalued market, check out this video right here. I'll leave a link in the description box below as well. So thank you so much for hanging out with me all the way to the end. If you did learn something new, consider gently smacking the like button right there. Subscribe to my channel, click onto the bell so that when I release future videos, I can let you know. If you're still bored, I left a video on the screen that I think it's incredible to watch next. And as usual, Otto will always do the honors, and I'm gonna see you very, very soon.